we're going to go over to our second keynote interview of the day, and it's with great pleasure that I'd like to introduce to you all Sarah Keohane Williamson. Sarah has a really distinguished career in the investment world. She is right now the inaugural CEO of FCLT Global. Some of you may not know the acronym, but I'll let Sarah talk through exactly what FCLT Global is and the genesis of that. But in her career, she's been formerly a partner at Wellington Investment Management, and prior to that at McKinsey, and also on the public side of things, I guess, in the US Department of State as a special assistant to the Deputy Secretary. So a real broad suite of experience and knowledge. I'm going to ask Sarah if she can talk, first of all, about the background to FCLT Global. I'll just reveal that it stands for Focusing Capital on the Long Term, but I won't steal any more of Sarah's thunder. Over to you to talk to us about where FCLT Global came from and where you're at the moment with its sort of, it's really been officialized now and as an organization. Sarah, over to you.
Okay. Well, thank you, Hugh. Thank you for having me here, and thank you all. I really appreciate your interest in this topic. So FCLT Global is the organization that grew out of the Focusing Capital on the Long-Term initiative, and that initiative was started about 3 years ago when Dominic Barton, who is the head of McKinsey & Company, and Mark Wiseman, who at the time was the head of CPPIB, which is the Canada Pension Plan, published an article in the Harvard Business Review decrying the costs of short-termism and urging investors in particular to think more about the long horizon in their investments. And it sounds like a very sort of simple idea, but the way that our capital markets tend to work is that they get very short term. So just to give you a little bit of a sense of what we're talking about, at one end of the value chain we have savers, people, real people who are probably saving for their retirement or the next generation or whatever it may be, but it's usually a long-term savings objective. And at the other end of the value chain, we have companies that are making capital allocation decisions. Maybe they're deciding to enter a new country or build a new factory or do R&D, whatever it is. And those decisions tend to be very long-term in their nature. But what happens is, in the middle, we have capital markets actors who tend to be short-term. And so those players are really the asset owners, so large pension plans, sovereign wealth funds, other asset owners, asset managers, so people who manage the money on their behalf, and the corporate boards and management who are feeling like they're facing pressure from Wall Street or wherever it's from. So the idea is that while the decisions should be very long-term, they tend to become very short-term, and that there are real costs both to the companies and the beneficiaries at the end of the day of that short-termism, and also to society much more broadly in terms of lost innovation and jobs and productivity. So that was the essential idea of where this organization came from. As I said, McKinsey and CPPIB were the initiators. The group expanded to 3 other founders who are BlackRock, Dow Chemical, and Tata Sons. And now the group also includes 20 other companies, large organizations like Unilever and AT&T and BP, large investors such as the government of Singapore, PGGM, Washington State Investment Board, and other asset managers such as State Street Global Advisors or Kempen in Europe. So the idea is simply that we have a group of people who are making very large capital allocation decisions across those types of actors and around the world, and that we are working together to create practical ways for people to be longer term in those decisions.
So you've got a heavyweight set of investors and corporates who are involved in this organisation. What's been the work so far, Sarah, and then maybe bringing us up to the present day, which is the really the sort of incarnation of FCLT Global? What have been the staging posts in terms of actual work done and outputs?
Yeah. So this group did, long before I was involved, did a enormous amount of work in terms of thinking about long-term mandates, so thinking about how does an investor put their money to work and how can they be longer term, as well as how boards can be longer term. And all of this is on our website, which is www.fcltglobal.org. And so that work was really done by these members in these various work streams. We then created an organization over the summer. I just started in July. We had our first board meeting on September 28th. So we're a new organization from that point of view. And our research agenda going forward is focusing really on three things. The first is, what is the cost of short-termism? Can we quantify it? Sometimes we get this pushback. Isn't long-term just a bunch of short terms or something like that? And it's not. And we're about to be able to show sort of the cost. But the costs of being short-term are very significant. The second question I'll get a lot is, how are you going to know if you're making any progress? How are we going to know if the world is getting longer term and it's thinking about capital allocation decisions? And so we're working on a gauge to measure that. And then we're working on a lot of capital markets innovations that we can talk about, if you like, that will help people in a very practical way become more long-term in their investment decision making.
And those are part of a series of papers that have been issued on the website.
Right. So there's there's a series of papers that have been issued already on the website, and then we will be pushing those even further. Right.
Okay. So the formal structure now of the organisation, what are you for those people who sort of say, well, you've come out of this article in the Harvard Business Review, there's been some papers produced, now you're a fully fledged entity. What do you look like?
What do we look like? Yeah. So we are a not-for-profit entity that is supported by those founding members and other members. We are based in Boston. We have a small staff of about 5 right now, in addition to the staff of our members who are working on these. But as an organization, yes, we're a not-for-profit based in Boston.
Okay, and just maybe a quick step back. What interested you in doing this on a personal basis? You've been in the investment management industry for a long time. You kind of know the structure of what happens here. Why take on this kind of role for you personally? It's all about the decisions you take in your career.
That's right. That's right. Or as some of my friend said, why are you doing something so crazy? So as Hugh said, I was at Wellington Management, the large institutional investment manager, for over 20 years. And I think Wellington is an extremely long-term place in the investment world. But I think what is really interesting to me about this idea, and the reason that I decided to walk out of a place that I liked so much, is that this idea of being long-term and how do we change the way our capital markets work to actually benefit the productive capacity at one end and the savers at the other end, is a hard intellectual problem. A lot of people say to me, good luck with that, or something like this. So this is a hard problem. This is not an easy problem to solve. So I think that is intriguing. I think the second thing is that the people involved are very serious about this, and there is the capital to move, right? These are not people from the outside sort of telling people who have capital to do this. These are people who are making large investment decisions every day. So I think the ability to have an impact is there. And I think that the potential impact, if we can pull this off, the potential impact is huge, because the statistics are pretty compelling. So just to give you a couple, one of the surveys that has been done tells us that 55% of CFOs would forego a positive project, a positive NPV project. So they think this is something that's going to benefit their company. This is a positive NPV project. That 55% of them would forego it if it meant missing their quarterly earnings target by 1 penny. Okay, that's crazy, right? Think about the lost innovation, or the factory that didn't get built, or the product that didn't get developed, and the effect that those things that could have happened, what might have on our societies. And so I think the potential impact is extremely large if we can make it happen.
And you mentioned, so that's a great stat to put out there, that effectively value-creating projects are being sidelined as a result of effectively hitting quarterly earnings targets. Are there other sort of data and argument points that you would put forward to someone saying, well, actually, it is just a series of short terms and long term. You know, well, this is not a problem.
Right.
What's your problem here?
What's your problem?
What you're trying to deal with?
Yeah. So I think one simple one in the U.S., last year in 2015, 99% of S&P earnings, S&P 500 earnings, went to buybacks or dividends. So essentially all of the earnings of the S&P 500 was distributed back to shareholders rather than redeployed into productive projects. Now, maybe that's because the entire S&P 500 has no ideas, but I don't think so. I don't think that there's nothing to invest in. So I think that there is this pressure to give the money out, be short term, and we all know that it's it's a bit of human nature. So I think that's one that's pretty clear, and that it has not been true historically. So this has changed over time. And even with the changes in our economy, which of course these days is much more of a knowledge economy than a physical capital economy, you can see this impact of the lack of reinvestment on innovation.
Okay. Sarah, what do you think the overlaps and maybe the differences are with what you hear in the ESG, responsible investment world? Where do interests align? Where might they be different? How do you sort of gauge the discussions that are being had here with the discussions that you're hearing on the work you're doing?
Yeah. So I think people use the word sustainability to mean a lot of different things. I think of long-termism as sustainable, and ESG may be sustainable. And so there are lots of words that mean similar things. They're not exactly the same thing. But the starting point for me is that if you own a stock for 30 days or 30 minutes or 30 seconds, you really don't care about ESG at all, right? That does not come in. Any of those concepts just don't matter. So I think that kind of the starting point or the necessary foundation for even beginning to think about all of these issues that everybody in this room has been talking about is the idea that somebody is a long-term owner. So that's, to me, is a baseline, that they'll be participating in this company or in the stock for long periods of time. And then I think that there are a lot of overlaps, which is people in this room this morning were talking about risks of stranded assets. Well, again, that is looking at the risk perhaps to the world, but also to the investor and the person making a capital allocation decision. So sometimes we may be looking at it more from what is the risk, let's take climate change, for example, what is the risk to the investor of climate change over long periods of time? Other people may be looking at the other way around, which is what is the risk to the climate of that investment? But at the end of the day, it's sort of two sides of the same coin is the way that I see it.
Okay. And you've been out talking to a broad spectrum of investors about the work that you're doing. I think probably in my career I've heard every institutional investor telling me they were long term, which is interesting. Yeah. What's the kind of response that you're getting from investors about what you're doing? Are they welcoming it? Are they sort of saying, well, hang on, why?
Right.
What are you hearing from people? What are they? What are the sort of nerve points that you're getting into?
Well, I think you're right. I think when people can argue about whether they want to invest in green bonds or not. That's a legitimate argument on both sides. There are very few people who say, well, no, I want to be a short-term investor. I mean, some I suppose, the high-frequency traders and a few others, but very few. Almost everybody, to your point, says, well, I'm long-term, and I want to be long-term, and I know it's the right thing to do, but I have pressure from, those other people, whoever those other people are. And so I think that the receptivity to this argument is that most people know it's the right thing to do. They just find it difficult. It's a little like eating your spinach or whatever it is. You know it's the right thing to do. It's just people don't always do it. So I think that people are excited about the idea of getting tools that will help them be longer term, that will help them do what they would like to do anyway, and what they know is actually in their own best interest. So I think there's a lot of interest in getting these conversations going across the different kinds of players, because if an asset manager feels that they'd like to be long-term, but their client, the asset owner, is going to fire them if they underperform for a quarter or two, then they can't be long-term, or they feel they can't be long-term. So how can we solve that problem? Or if a company feels like if they miss their earnings, that they're going to get punished by the asset manager, they're not going to miss, and they're going to do other things to make sure that they don't miss. So I think there's a lot of receptivity. I think that the pushback that it's not a problem typically comes from either people who don't make capital allocation decisions and don't realize how hard it is to be long-term, or people who make their living from turnover.
Okay, let's maybe get you to eat a bit of your own spinach.
Feel free.
So I recall when we chatted, you'd mentioned that you're going to be a do tank. So what does a do tank do? And what exactly are you going to be producing to sort of to start trying to tease away at those business model questions that are really quite often at the heart of this long-term, short-termism issue?
Well, let me give you a couple of examples, and we can go into the weeds of finance for people who like it, and I won't do it for those of you who don't. But just to give you a couple of examples, one is about quarterly guidance. So most of you probably know that in this country, it's not common in some countries, but in this country, it's very common to issue quarterly guidance and then to have to hit it. And it's also common to issue at a certain point, $2.73 per share or whatever it is. Which, by the way, we don't usually make point forecasts for most things. Like if you look at the weather forecast, it doesn't tell you it's going to have, 3.1 inches of rain. It says it's, 75% chance of rain. But for some reason, there's this habit in quarterly guidance, we make these point forecasts. And then there's this reluctance to miss it. So that is one thing that we're working on. The challenge with quarterly guidance is that some of the academic research that's been done looks at people who have given up quarterly guidance, and they tend to underperform. Their stocks underperform. And so people say, well, people give up quarterly guidance, underperform, so I don't want to give up quarterly guidance because I'll underperform. But the problem with that logic is that right now, the people who give up quarterly guidance are the people who are going to miss it. And so they give it up because they've got a problem in their business, and then, of course, they underperform, but then it looks like giving up quarterly guidance is a bad idea. So in boardrooms across this country, there are lots of people who say, I'd like to give up quarterly guidance, but I don't have the backing to do it. So that's an example of something where we think we can do the research and provide a little bit of the, maybe safety in numbers, if you want to call it that, to give that up. Some of the other ones that may be a little bit more in the weeds are things like risk measures in long-term capital management. So, for example, most people in the investment business, when they use the word risk, they mean one-year volatility, and that's because that's what that has been taught to people in business schools for the last 50 years. But it doesn't actually make any sense if you're managing money for 10 or 20 years to think about one-year vol. And changing that even to a 3 or 5 year actually changes the capital allocation decision because it changes your numbers. So then there are a number of other issues like dual class shares. There are a number of companies in this country that have founder shares or dual class shares. Those aren't allowed in some countries. And so part of the question is, are they actually effective at having people be longer term? So we're doing some research there. And then I guess the last one I'll mention is the pricing of options in a buyback. So as you all probably know, when somebody buys back their stock, then you obviously have fewer shares outstanding, so the average price of the stock is higher. But most executives in this country are paid in options where the strike price is set in absolute dollars rather than relative to the number of shares outstanding. And so not that necessarily people are thinking that they're doing this, but there is a built-in incentive to have a buyback and therefore push the price above that strike price, even if there's no actual value created by doing that. So that's what I mean by being a little bit in the weeds of how some of these things are done and trying to change the math a little bit and do a bunch of nudges rather than we're not trying to ask, we have members in 10 countries. We're certainly not trying to ask governments of 10 countries to change the way they operate. We're trying to poke at these things that perhaps change capital allocation decisions.
You're poking at some pretty big beasts there. Let's open up to the audience for questions. If you could, if we can get a mic, keep your hands up. We'll get a mic to you as quickly as we can. If you want to ask a question, stick a hand up. We'll try and get round to you. If you could give your name, company, and your question as quickly as possible, please. I'm a bit of a stickler for questions rather than statements. So
Sure.
We'll keep your hands up. And
My name is Allie Edelstein. I'm coming from Yum Brands. And I guess my question is, we're not seeing companies here. And so I'm hearing from you all that you're looking for forward-looking metrics. You're concerned with the short-termism of capital allocation policies. But as a sustainability professional in a company, all I'm getting is surveys that look at static metrics and that reward our company for capital allocation like we do through share repurchase programs. And so I guess my question is, what is the disconnect, and why are players like Adam Cancer over at Domini, who submitted shareholder proposals on capital allocation policies related to share buybacks and executive compensation, not being supported in their efforts fully?
So it's a great question. So I think that part of this is why are people not being supported? And we talked about, earlier the Exxon Mobil, and there are lots of discussions going on around corporate governance and various shareholder proposals, which I think many of them are terrific. But I think that it is human nature not to like to be told what to do by others. And so I think in a lot of ways it's better if we can figure out if being long-term is better for a company and they actually believe that in their soul, and they are incented in a way that they benefit from that long-term value creation, and then you don't sort of need somebody coming in from the outside and telling people the way that they should run their business. And so I think that not that that can't work, but that if we can do it by helping people understand that they can do well and do good by being longer term, it's actually a little bit easier to get it done. And another example I will give is one of the other phenomena we're having in this country, which you may be familiar with, is that companies are trying not to go public. So Uber, for example, and many others, companies that in almost any other time frame would have been public companies. They're very large companies. They have a lot of revenues. They have a lot of employees. In most eras, those companies would have been public. They're trying not to go public because they feel like the public markets put this short-term pressure and this sort of, beating on people at how to run their businesses. So one of the things that we think is very dangerous is if you got to a situation where new, creative, innovative, long-term looking, forward-looking companies opt out of public markets and are only held by accredited investors and people with very large amounts of money, and kind of, the others are held by the public, that's not a good outcome. So I think what we're trying to do is have a little bit more of the capitalist fixing capitalism, if you will, rather than the people from the outside trying to do that. But that may also work as well.
Great question. Thanks for the answer. Questioner here at the front, and let me know if you want to come in, and we'll try and get as many of you as possible.
Great.
Quick questions, please.
Sean Stoner from Intelligent. I'm wondering what your most salient piece of advice is to, say, like CPPIB or any of these large asset owners. How do they restructure incentives for their fund managers to bring in long-term thinking? Yeah.
For the fund managers that they hire externally. Right. So we're working on the details of that, but essentially it really comes down to incentives. Incentives incent, as the old saying says. So there are several ways to do it. One is to have performance-based fees, which is the simplest. The other are trade-offs between fees and lockups, which are increasingly common. In other words, if money is invested for longer, you get a lower fee, and so that encourages both parties to have a longer term. Others are clawbacks and other sort of things that, so you may know that typically there are high watermarks in many performance fees, which means if you make a lot of money and you drop, you don't get paid until you get back up there. But most of the time, there are, if you think about the math, that you actually have an option value to kind of take a lot of risk and go through that number. And so if you can restructure those such that there is more alignment, it's really all about incentives and alignment. Yeah.
Okay, let's take the question over there as quickly as you can, and we'll get round and try and get as many of these as possible.
Hi, Heidi Welsh, Sustainable Investment Institute. So one of the a big feature of the U.S. is the sort of very robust shareholder resolution process. And I noticed that a number of the, a couple of the big mutual funds are active with your organization, including BlackRock and State Street, which in general do not vote in favor of any shareholder resolutions on environmental and social issues, although they raise long-term issues. I'm just wondering what you feel, or your organization feels, is the role of sort of the shareholder engagement process in identifying long-term risk and opportunity, and why and what makes the mutual funds vote as they do.
Okay, where do I start on that? So the first thing I guess I'll say, which is probably pretty obvious,
You're getting a really easy question.
Is that I'm not speaking for BlackRock or SSGA or any of the other members that we have. But having come from an institutional investment manager for most of my life that manages mutual funds, I think that there are a couple things. I think the first is particularly people who are going to own that stock for a long period of time, and in some of those cases, especially if it's a passive fund, they're going to own that stock essentially forever. They don't have the ability to sell the stock if they don't like the company. So I guess the way that I would think about it is different sets of investors have different sets of tools. And so let's start with the passive. So the passive managers, on average, are very, very large, and they don't have the tool of selling the stock if they don't like what the management's doing. So they're really focused on conversation and engagement with companies if they're going to make a difference. And so I think that many of them have built up teams that can do that much more, but they tend to be a bit more behind the scenes than some. Active managers, so where I was, for example, have the ability to sell the stock if they don't like it. So they will tend to often be less likely to engage because they can walk away. Other investors use different sets of tools. So the way that I would think about it is, for any investor, they need to think about what are the tools at their disposal and how can they use those tools to maximize the long-term value of their investments for their shareholders, and they should rely on using those tools that they have.
Okay, thanks for that, Sarah. Let's take someone has a microphone somewhere. Be quick.
Hi, Ellie Levin, Impact Capitalist. So two questions. One on the regulatory framework, and how do you think about that incorporating into this notion? Because it feels like a lot of the pressure comes from the fact that it's just mandatory from accounting standards to disclose on a quarterly basis. But can we transition it to a point where it's actually we emphasize the importance of reporting on like a 3-5 year basis on key financial metrics, and then quarterly basis just some basic stuff so institutional investors can monitor how their investments are doing? And second quick question on Unilever, because I think they've actually been a leader in transitioning towards sort of getting rid of guidance. So has there been any studies on that in terms of has that helped their performance?
Okay. So first on Unilever quickly, and Paul Pullman of Unilever is on our board, and again, I'm not speaking for him, but they have done he's been very outspoken about quarterly guidance, and I think that company has done a very good job of being out front, not just on that issue, but a lot of things. So I see him a bit as a leader in this area, and I think a lot of people have followed his example or have tried to. In terms of the quarterly reporting, my own opinion is, and we still need to do more research on this, but my own opinion is that quarterly reporting is not nearly it's not in the same category at all as quarterly guidance. And that I think our chance of moving away from quarterly reporting in most countries is probably low. There has been some effort in the UK to move away from quarterly reporting. But I think that we live in a world of more transparency, instant information. You can all check, what a stock did this last second on your phone. So I think a little bit that's pushing a boulder uphill. I would say that having reporting that is clear and focuses on the important things is part of the challenge. Right.
Okay, let's take the question there, and then we'll try and get a question in here as well.
Hi, Cornelius Grotner with Lula. You mentioned, companies like Uber not going public because to escape short-term pressure. So there is, a couple of Silicon Valley types that work on the same issues. I think Eric Ries, Lean Startup, you know, the long-term stock exchange, Mark Andreessen is in the book. So can you talk a little bit about what kind of cooperation there is sort of like between the, you know, Silicon Valley tech types and sort of like the East Coast sort of like money and classic investor types?
Okay. So what Eric Ries is doing is really interesting. For those of you who don't know, he has written a book called The Lean Startup, and he's also working on an alternative stock exchange, a long-term stock exchange mechanism. And so, and we are collaborating with him, and we've been in touch with him. So the way that I think about this is that there are people who are experts on corporate governance or stock exchanges or whatever that may be. And what we're trying to do is overlap with them in terms of where sort of the Venn diagram crosses of having that be long-term. And we're really open to that. In terms of, you know, where this comes from, I think that I don't think that long-termism is a Silicon Valley thing or an East Coast thing or a U.S. thing or a developing market thing. Or I think it's appears in all those, and short-termism appears in all those. So some of the most long-term oriented companies are tech companies that realize how quickly the world is changing. Like Amazon doesn't just sell books on the internet, right? I mean, that at all. So the way that I think about what's a long-term company and what's a short-term company is that short-term companies tend to be pro-cyclical, and short-term investors, right? When the market drops, they sell. And we all know what happens to people who do that consistently. Longer-term investors and thinkers tend to be counter-cyclical. So if business conditions are bad and other people are laying people off, they go out and try to hire the best people. And so I think that part of the question is it's not necessarily what industry you're in or what game you're playing. It's can you take that counter-cyclicality mindset to whatever that task is, rather than the pro-cyclicality mindset that gets people into this short-term kind of rat race.
Okay, great. One last question, as quickly as you can, please.
Hi, I'm Paul Hewitt from Vigio Iris in the UK. In my other part of my life, I'm a deferred member observer on a public sector pension scheme in the UK. We have a liability project of about 117 years. Most of our mandates are between 10 and 15 years in place. The elected members who make the decisions face re-election every 3 years. Our asset managers rarely tell us anything, rarely present their focus on more than the last year because they come to see us annually. Our investment advisor tells us about economic and political developments over the last quarter or the last year. Where do I start?
Okay, so it's a great example.
We should have had this question at the start.
Yeah, no. So one of the things at the top of our list is kind of this asset owner, asset manager mandate, which I alluded to. But this, you've made a better case for it than I could ever. So that's exactly what happens. And it doesn't just happen at your plan. It happens in plans around the world that have very, very long-term liabilities, but they become very short-term. So what do you do about it? The first is you think about the way the reporting actually works, and that is the time frame of the reporting and the risk measures that are involved. You think about the governance structures and why are those people elected every 3 years? Is there a way to change that? And you think about the way that managers are hired and incented and how their contracts are renewed, and is there a way to change that? So it is, as I said, sort of in the weeds, tweaking those things. It's not a magic wand, but I think if every meeting that you're in, you say, is that in our long-term interest, or are we focusing on this quarter or this year, and remind people that your liabilities are in decades, that will be a great place to start.